This stock market rally has been absolutely historic. In fact, it has been the best stock market run we have seen in history for this period of time. We're going to go over that, but why that this market may not last, or we are potentially in a major asset bubble. It's all looking forward at what is to come next week with almost a sure guarantee of cutting interest rates. But we're going to go over all of that. But first, we got to start off with how this 5-month market rally is literally the best 5-month, market rally in United States history. We are up 36% since April of this year. Now, it's interesting because if you look at everything, right? Look at it holistically. Producer price index, or PPI, those margins index fell 1.7 month over month, and its lowest since April, marking the largest decline since July 24. And this is the second largest monthly drop in 6 years, yet we're having the largest 5-month rally in stock market history. PPI margins measure the difference between the producers and the cost of producing them. The profits have declined, yet, like I said, we are still seeing major stock market rallies. So if we look at the 5 key takeaways from this inflationary report, we're going to be diving in to how this is related to the stock market, but also how this is almost somewhat of an illusion, because if you really take a step back and look at the facts here, we have inflation still at 2 to 2.9%, well over the 2% mark that the Fed claims it's their quote unquote target. But we still have a stock market rally. Yet, if you look at housing, housing is hurting significantly. Now, why is housing hurting significantly, but the stock market is rallying like crazy? Well, it's because of a few different factors that will go on later in this video. So make sure you guys are hitting that subscribe button and smoking that like Cheech and Chong. But there are 5 key takeaways from this report. PPI showed outright deflation in what is generally considered a measurable pipeline pressures across the country. And they've been looking for a 0.3 increase. The core PPI strips out food and energy, which also fell to 0.1%. So core minus trade services actually rose 0.3%. The tame reading will only feed market expectations of a Federal Reserve cut. Just out, no inflation, too late, pal. Classic Donald Trump. Now, this time, inflation nears certainty of a rate cut. Fed officials look not only at the headline numbers, but underlying drivers. It showed good news. Inflation fundamentals. The services sector, which drives 80% of GDP, saw outright deflation. Even goods priced more heavily impacted by tariffs rose just 0.1%. So this CPI reading that came out on Thursday got more attention. And like I said, it was at 2.9%. But it's interesting because if you look at the data here, the data shows that 1/3 of all states in the United States, granted there's 50 of them, plus or minus Puerto Rico, depends how you want to look at it. But 50 of these states, 1/3 of them are already in recession. So if you look at it, the big major ones are New Jersey, Illinois, Virginia, Georgia, Washington, Iowa, and Oregon. Yet Cali, Texas, New York, Florida, those are all expanding. So it looks like the goods producing sectors like agriculture are already in recession, but technology, healthcare, and real estate are expanding, while financial services and retail hospitalities are barely holding steady. So it just varies by state, which is very interesting because you usually do not see these things drastically be so different with different companies, or different sectors, different states. Yet, if you take a step back, U.S. mortgage rates are posting the biggest weekly drop in a year. Granted, it's from 635 since the lowest are yeah, so it's to 635, the lowest since October 10th of 2024. So we're seeing the drop in real estate start to trickle on over, but it's not necessarily here to stay, is it? I mean, if you look at the overall asset prices, they're starting to go up dramatically. Now, will this drop make sure that housing really has a rebound? Because we've had a housing market be in fairly stagnant locations, but everybody's saying that housing has become unaffordable. So, will houses now skyrocket? Will we see those prices go up? Or is it just the stock market that is going to rally through all of this? I mean, if you keep looking at the cumulative fiscal budget deficit, this chart is up and to the right. I mean, the 345 billion budget deficit in August is the largest monthly deficit of 2025 and the second worst August on record. So we're setting records in the market going up and also on some of these negative values as well. So it's interesting. This July is up from 291 billion deficit and is only surpassed by last year's $380 billion deficit. Government spending surged 689 billion for the month. Through 11 months of the fiscal year, or yeah, the US deficit is now up to 190 trillion, 1.97 trillion, on track to be the third largest annual deficit in history after 2020 and 2021, where we saw massive amounts of money printing, right? The QE happened those years. Now, if you will see and keep track of all of this, you see the NASDAQ closing at that record high and the S&P having a winning week as that, quote, Fed decision looms. Look, I don't even think the decision is looming anymore. We know what's going to happen. The Fed's going to cut interest rates. Look at this, 96.4% prediction here that the Fed is going to cut interest rates. But what does that mean, right? If they just cut by 25 basis points, is the market already pricing that in? It seems so. The market has priced in about 3 rate cuts before the end of the year. So if we see a 50 basis point cut here next week, which is there's only a 3.6% chance, I think we will see a major market rally. Now, if we, on the flip side of things, if we just see that 25 basis point cut, I really don't think we will see much of the market turn. So it's interesting because when the Fed is going to cut interest rates, the market always tries to price this in prior, right? So as these things continue to get priced in, I'm going to be following it very closely, and we're going to keep on going through some of the things that I see that are negative with this interest rate cut. So make sure you're hitting that subscribe button and smoking that like for me. But we've seen the tech-heavy NASDAQ close 0.44% higher than its previous all-time high, surging in Tesla and the broader market flatline. So, I mean, it's another thing, right? I mean, these tech companies are really just carrying the S&P 500 and the NASDAQ and all of these major indices. And the S&P 490 is getting carried by those 10 companies. And that's why we keep seeing it. The disillusion of the market is massive. And so big tech will keep lifting these to do, excuse me, new market highs. I guess I'm allergic to inflation, folks. And the hedging of all this inflation keeps going up as well. We've seen it's hedging against a 10% drop in the NASDAQ, the QQQ. The relative cost of hedging has risen 40%. I mean, it's massive. As a result, downside protection on QQQ is now higher than it's been in all but 8% of recent cases. Investors are now adding hedges to protect long equity holdings from a potential market drop. And this also signals growing caution ahead of long anticipated September Fed meeting all week. So like I said, we're going to continue to watch and keep and monitoring this, because even though we have the Fed going to cut interest rates, the Dixie, what we see here, I don't think is exactly positive, right? When we see the Dixie floating around 96, 97, right? We haven't really seen a huge positive sign in all of this, but there's $15 trillion that got added to the market cap of the S&P 500 in 5 months. $15 trillion. While a third of the states are now looking at a recession, and inflation just adjusted in gold prices is essentially hitting that record high. The first time since we've seen this at this high since the 1980s. So inflation plus rate cuts equals gold's dream setup. So it's absolutely massive that we see this massive amount of inflation here. And yet the market is responding as we all expected, right? The market, because it's more liquid than real estate, this is why the stock market will thrive in an environment like this, but real estate will not, because real estate just in general has become more unaffordable. We're seeing more home buyers this year over the age of 70 than under the age of 35. And this is the first time we've ever seen this in history. Full stop. We're seeing historic runs in the S&P 500. So the market dynamics are the rich are getting richer, the poor are getting poorer, and whoever has assets is winning. And that gap is just widening like crazy. So you guys need to be keeping a very close eye on the overall market, because I think we're going to be in one of the biggest asset bubbles we've ever seen. Now, I don't necessarily think that this asset bubble is going to pop anytime soon. And when I do, I'll be sure to tell you guys on this channel. So as All Nighter Hider is saying here in the chat, smoke the like and hit the subscribe button, because I'm going to be covering this very closely here. And thank you guys all for coming out, and I'll catch you guys tomorrow.